Welcome to our in-depth guide on investment risk. Today, we'll break down what investment risk is, explore its different types, provide real-world examples, answer common questions, and even analyze data to give you a thorough understanding. First, let's define investment risk. Investment risk refers to the possibility of losing some or all of the money invested, or the investment not delivering the expected return. Understanding the different types of investment risk is crucial, so let's dive into the main categories: market risk, credit risk, liquidity risk, and operational risk. Market risk refers to the chances of an investment losing value due to economic developments or other events that affect the entire market. For instance, if you invest in stocks and the stock market crashes, your investment will likely lose value. Historical data from the 2008 financial crisis shows a sharp decline in stock prices. Here's a graph showing the S&P 500 index during the 2008 financial crisis. Now, let's talk about credit risk. Credit risk is the possibility that a borrower will default on their financial obligations to the lender. A common example is investing in corporate bonds. If the company issuing the bond goes bankrupt and fails to pay back the bond, you face credit risk. During the 2008 financial crisis, the largest U.S. bankruptcy was the collapse of Lehman Brothers, which led to significant losses for bondholders. Here's a graph illustrating the rise in credit default swaps, CDS, around the time of the Lehman Brothers collapse. Next, let's explore liquidity risk. Liquidity risk is the risk arising from the difficulty of selling an investment without affecting its price drastically. For instance, real estate assets can be less liquid compared to stocks. Selling a large property quickly might mean accepting a significantly lower price. Here's a visualization showing how real estate transaction volumes dropped during the 2008 financial crisis due to increasing liquidity risk. Furthermore, operational risk involves losses due to failed internal processes, people, and systems, or from external events. This includes risks such as fraud, regulatory issues, or technical failures. A historical example is the massive trading loss at JP Morgan in 2012 due to inadequate risk management systems. Let's now answer some common questions about investment risk. Question 1. How can you manage investment risk? Answer: diversification is one key strategy. By spreading your investments across different assets, you reduce the impact of a single asset's poor performance on your overall portfolio. Question 2. What is the relationship between risk and return? Answer: generally, the higher the risk, the higher the potential return. However, high risk also means a higher chance of losing your investment. Here's a graph showing the risk-return profile of different asset classes from 1990 to 2020. Let's recap the key points. Understanding the types of investment risk, market, credit, liquidity, and operational, is crucial for managing your investments effectively. Always remember, diversification can help manage risk, and the potential for higher returns often comes with higher risk. Thank you for watching. Stay tuned for more in-depth financial topics.